Okay, good morning, guys. Welcome. Friday, 7th of August. Market down. Potentially could be one of the most important days of the year. Payroll's coming. We've got obviously 5 hours yet until this stuff hits the wires, but it will of course dominate the session and could easily be, well, we'll have to see what happens, but I mean could be information flow that actually shapes market behaviour for weeks to come. So I'll talk about that in a minute. Obviously the big event of the day. Let's look at yesterday first. So, you know, the big move yesterday really was on the equity space, with the S&P notably underperforming. Big sell-off, big sell-off, 25-point sell-off really from the US Open through to pretty much the European close. Heavy stuff, and really came as a little bit of a surprise, you would say, that given that the sell-off began at 2:30, we didn't really have much data flow from the US yesterday. We had jobless claims that came in absolutely fine, in fact better than fine. It just means that the 4-week moving average remains at kind of decade lows, and so we know this. Jobless claims numbers have been phenomenally good for months now and continue to be so. So there's no barrier in the way for the Fed from a jobless claims point of view. So let's maybe just talk about what happened here and why we got a decline, and I think that it's twofold. Well, maybe even three, actually. Let's add a third in there as well. So I'm going to give 3 reasons why the S&P notably underperformed yesterday. Reason number 1, probably just, and this isn't the most important one, but certainly relevant. And so this is probably just ahead of payrolls today, because don't forget that from a cash equity point of view, yesterday was the last chance to trade cash equities before payrolls, because non-farm payrolls gets announced at 1:30, and that's before the cash market open. So perhaps a lot of this movement, or some of this movement yesterday, was as a result of a bit of nervousness ahead of payrolls today. I think that ISM non-manufacturing number, coupled with the jobless claims figures, were enough. I know we've had mixed data this week on the labour market, with the ADP report being disappointing, but outside of that it's actually been pretty strong. So, and particularly that ISM non-manufacturing report showing just remarkable numbers, including the employment component, record ever increase in a single month. So I think that maybe you got a little bit of nervousness ahead of today, and well, whilst I guess I've mentioned payrolls now, so let me just kind of talk about this, and then I'll come back and talk about the other factors that I think have led to the S&P moving lower yesterday. But if there is nervousness, so what does that mean? Obviously this information's phenomenally important for the determining the timing of when the Fed are likely going to hike rates. So what needs to happen today, and what needs to happen at the start of September, because we've got 2 payrolls reports before the next Fed meeting, and what kind of figures do we need to see? So here's the chart of payrolls over the last 12 months, and you can see it's been volatile. You've had a high of 423,000 and then a low of 119,000. So there's definitely more volatility in the payrolls data, let's say over the last 8 months, than there has been over the preceding 12 months. We had 12 months in a row of plus 200,000 figures until we kind of hit this year, and it's got a little bit more volatile. We've got 2 numbers below 200,000 this year already. But you've got to look at the averages here, and this is perhaps what the Fed will be looking at. So the average payrolls, the 3-month moving average, is actually at 221,000. If you look at the last 3 months, 221,000 is the average. If you look at the 12-month average, or actually, sorry, if you look at the year-to-date average, So actually this doesn't include the punchy numbers we got at the end of last year. Take those out. So the year-to-date average is 208,000. And 200,000 is important. I think as long as you get two numbers today and then at the start of September, if you get two numbers above 200,000, from the Fed's point of view, I think that will be sufficient. If all they're looking at is the job creation statistics, then I think that will be sufficient for them to hike rates. The only thing is, of course, they're not just looking at that. They're thinking about inflation, they're thinking about wage growth, they're thinking about international risks with China and so on. So if they were just looking at the labour market, they said that they wanted to see some further improvement in the labour market, and I think that some would be two figures above 200,000. You know, the little bit of volatility we had earlier in the year where we saw a decent dip in March. You know, if we get two readings above 200,000, that would say to them that things have stabilised. We had a bit of a wobble earlier in the year, but we're back on track with consistent, strong job creation figures. So we really need, all we need is a couple of numbers above 200,000, I would say. And just as long as this year-to-date average doesn't drop below 200,000, and it's on 208 at the moment, okay? So if that barrier is fairly low, you know, I'd say it's pretty likely we're going to get exactly that. And I think the ISM non-manufacturing data and the jobless claims figures have really said to traders it's unlikely we're going to get sub 200,000, so maybe we should really start worrying about this September hike. So maybe this was some of the move that we saw yesterday. But there are other factors involved, and I want to talk about two things. Firstly, the media sector. So the media sector is having a nightmare. In fact, over the last month, the media sector has had their worst month since 2008, which is fairly extraordinary. November 2008 was the last time the media sector of the S&P 500 performed this badly. So more bad news on this yesterday. Viacom, so maybe a lot of this was earnings. Viacom reported earnings that were very bad. Their stock price dropped 14%. And this is more of a kind of story that's not necessarily new for Viacom, in that their share price has been suffering quite considerably. For example, their share price is 46% lower than it was 12 months ago. So, you know, you're getting notable underperformance from Viacom as the likes of Netflix kind of take over the world. So Viacom have been weak. Walt Disney have been very weak. 21st Century Fox, they dropped 6% yesterday as well. So these media companies underperformed pretty dramatically and definitely had a large part to play in dragging down the whole the whole index. Add on top of this the fact the oil price dropped again yesterday. We've bounced a little bit. We're just shy of yesterday's kind of highs this morning, but we're 30% off the high. So another move to the downside yesterday. Perhaps I was going to say put energy stocks under pressure, but ironically, we actually saw some of the energy stocks outperform yesterday, which is interesting. So actually energy stocks weren't really a part of this move to the downside. What we did get, though, was Apple. Apple moved lower again yesterday. And let's talk about this index. I'm going to go to a daily chart for the S&P. Okay, here's the daily chart. You know the story. We've been consolidating and flat for months and months now. And this market is, let me just show you I'm going to go to a yearly chart. I just want to show you, if this loads for me, I want to show you the year-to-date performance. Sorry, my chart's just taking a while to load up here. I'm going to show you a year-to-date performance, and if this chart loads up, there we go. If I hover my mouse here, basically, actually, we're only 1.2% up on the year. And here we are. I mean, we're in August. So far this year has been a complete, no real growth in the US share index story whatsoever. So of this growth, the only problem is with Apple declining over recent days. And I'll bring up let me see if I can get a chart of this. This is let me sort this out. this is a look at the Apple share price. We're actually going back long term here, and what's happened over the last few days, and of course this was triggered off the back of their earnings report a couple of weeks back. They were trading up around their all-time high, up at $133, and then bang, huge move lower. They're actually now down over 10% over the last couple of weeks. Their share price now trading around about $115. Technically, it's looking very negative. Breaks below the 50, the 100, and the 200-day moving averages. Trading down below the 2014 high, and technically looking negative, technically looking like it wants to make a move to test the 100 handle, which is a very important price point. But Apple's such a huge portion of the index, and actually the year to date, and this is before yesterday, the index was up about 2% on the year, and actually all of that upside for the year is purely as a result of 7 companies. Remember, there's 500 companies in this index, and yet if you took 7 of them out, this market would be down on the year. And the 7 are Amazon, Google, Gilead Sciences, Facebook, Netflix, and then the last 2 are Walt Disney and Apple. Now, the only problem with the last 2 is they're the 2 that have been suffering more than most over the last couple of sessions, and well, for Apple over the last couple of weeks. Walt Disney have been very weak because of some of their earnings guidance going forwards, and of course Apple have been very weak, as I've described. So this index has been able to stay up at unchanged on the year purely as a result of 7 companies. So this doesn't particularly bode very well for the index if these individual companies, and 2 of them are really now under pressure. Amazon, for example, I mean, they were up 20% off their earnings. So if you took that out, then we'd be trading way down. We'd be trading down around the lows of this range we're in, down around 20, 32, 50, and back to kind of unchanged and negative on the year. So I think we are a little bit vulnerable here on the S&P. Its current levels are dependent on just such a small number of companies. And I think if you get a trigger point, and it might be today, if you get a trigger point like a very powerful payrolls number or a really high average hourly earnings number that really starts to significantly raise expectations about a September hike, then I think we are quite vulnerable here on this index. It's really been flagging for the entire year, and it's not going to take much to tip the balance, I don't think. So that's the reason for the weakness yesterday. Media sector leading it. Nervousness ahead of today's payrolls data. That's the kind of 2 catalysts. Now, sorry, I'm having a little bit of trouble with my charts here. Let's move on. Let's talk about, well, you've got a bit of upside here for the euro dollar this morning. Interestingly, ticking higher, testing this key price point around 109.50. This was the high point on the 5th of August, the high point on the 6th of August. It's currently now, well, just for now, roughly the high point on the 7th of August as well. So we've got a bit of dollar weakness in the mix. We've got bond markets coming under pressure. If you look at the Bund here, trading down on the low of the day, testing the pivot at the moment. You've got equities moving lower as well. So it's a bit of a mixed picture, because on the one hand, if the dollar's weak, bonds are selling off, so yields are rising. Well, that doesn't make much sense if you're trading the beginning of the day where all eyes are on payrolls, because you should get these markets moving in sync, i.e. you should either expect a hawkish payrolls report, which would mean dollar strength and bond market weakness. But you've got bond market weakness and dollar weakness at the moment, which is a pretty confusing one, I have to say. These should move back into tandem and into sync as we hit this afternoon. So you've got an interesting bit of divergence here between the dollar and the debt markets at this point. So the dollar's weak, bonds are weak, stocks are weak. That's pretty much the theme. And because the dollar's weak, oil's been able to bounce a little bit. So yeah, you see the look at my DAX chart on the top right. We're now down below yesterday's low here, trading down below and down towards the 11,500 handle. So a little bit of weakness. Now let's just have a little bit more of a chat about payrolls, because it's not just the payrolls number itself. And actually, let me maybe just bring the economic data calendar into view here so we can talk about what's coming up. So what's left today, we got a bit of UK trade balance figures at 9:30, but of course it's all about the 1:30 event. And so loads of figures being announced. It's not just payrolls. By the way, we're expecting that the forecast is 225,000, all of which are expected to come from the private sector. We've also got the unemployment rate. That's expected to stay unchanged at 5.3%. And when we got the average hourly earnings figure, so it's expected to be on a monthly basis plus 0.2%, on an annualized basis plus 2.3%. Here's a look at the unemployment rate chart, which has been very consistently declining. Last month down to 5.3, a new cycle low. That's the lowest since before the crisis. And there's a chance this could go even lower. I mean, this could trend down below 5% by the end of the year. If we get solid, plus 200,000 payrolls numbers into the end of the year, which is, absolutely reasonable to expect, then you should get the unemployment rate dropping below 5%, which is quite incredible. A lot of you may not know and may not have been trading and monitoring markets back in 2013. But the guidance Bernanke gave in May 2013, pretty much, he said that they'll start to look at raising interest rates when the unemployment rate drops below 7%. That was his guidance. Here we are down, about to test 5%, and still rates stay unchanged at 0. So they kind of screwed that up a little bit, and that's the Bank of England also made the same mistake. But anyway, this unemployment rate is way down, back to normal levels. The Fed, so in terms of barriers to the Fed hiking in September, there's no barrier from the unemployment rate. This is absolutely fine. This is ready to hike. If payrolls deliver two readings, 200,000 or above, then that's also not a barrier. The Fed can certainly hike. I think it's the average hourly earnings figure that is more of a barrier. This is just the month-on-month chart. We got a 0 print last time, which was disappointing, worse than expected. We also revised down the month before. It was plus 0.3. They chopped it to plus 0.2. Today we're expecting plus 0.2 again, which is fine. It's not setting the world on fire, but 2.3% on an annualized basis basically puts us at the top of the 3-year range. If we get an annualized figure that's above 2.3%, that'll be quite significant. That'll put it at a 3-4 year high. And then again, this average, then the wage growth thing may well also present no barrier to the Fed hiking. So don't for a second ignore the average hourly earnings numbers. They could well be the most important figure that gets announced this afternoon. So, yeah, maybe the labour market is where it needs to be for a hike. The only problem is that from a GDP point of view, just keeping a track of the Atlanta Fed GDP forecaster, they're actually currently tracking at just 1% for quarter 3, 1% growth, which would mean if the Fed did hike in September, it would pretty much be, how do I describe this? It would be the first time the Fed have hiked rates with GDP being so low. So the GDP factor definitely carries a barrier to hiking in September. And then, of course, it's the inflation outlook, which continues to remain weak. And with the commodity prices cycling lower over the last 5 weeks, that means that inflation should stay lower for longer. So I think the labour market doesn't present a barrier for hiking, but GDP growth and inflation outlooks do. So we'll see. So big numbers, of course, this afternoon. Right, that's it for now. We're going to do a full-on preview to payrolls later on ahead of the event from about 1 o'clock. But for now, we've got an interesting first early exchanges here on these markets with stocks coming under pressure. The S&P bounced last night, but it's just now sliding a little bit again. So target on the downside is yesterday's low at 2070. You've got European stocks just drifting lower as well. You've got the dollar being a little bit weak, and you've got bond markets under pressure. Oil prices bounce back up, and for now trades above $45. All right, guys, enjoy the session, and just remember, just keep your powder dry. Don't be the one that gets stopped out this morning before the main event. All right, just play it cautiously. All of today's price action, or let's say 90% of today's price action, will come after 1:30. Okay, remember that. Speak later.